I did the homework and all other things. I don't think I did. Uh, I was going hard.
So we accounting for partnerships is what we're talking about today. And let's start with that. Just first defining what a partnership is. So, what is your idea of a partnership? What is it?
When two people come together to, well, bring funds together to allocate a business and to operate a business.
So, two people coming together with money
Well,
to start a business. Yes,
Two or more,
it
yeah.
is correct. Mr. Coleman is two or more individuals coming together, forming a business, investing resources that they have together to form a partnership. And what we want to look at now, which is what I have on the screen, is how we form a partnership. And there are so many different components inside of that you need to remember. And the reason you need to remember them is because chapter 13 talks about corporations, and that will be substantially different. So, first thing we want to talk about is when you're forming a partnership, voluntary association. Voluntary association. In other words, partners voluntarily go into business together, right? And because they decide to go into business together, it doesn't have to be a formal agreement in place. It doesn't have to be a written contract. It could all be put together verbally. Okay? So it's one thing you need to know about voluntary association. Generally, the people who go into partnership together already know each other in most cases. They choose to go into partnership together. And if they choose to go into partnership together, it doesn't have to be a written or formal agreement put in place. That's not a requirement. If they do, great. If they do not, it is all considered to be verbal. Um, Next would be the partnership agreement. In the event that they do decide to write, do a written agreement, that agreement is going to stipulate a lot of things about the partnership. Um, One being, how are they going to receive income from it? Because obviously everybody's in the business to make money, right? And as money is being made, because it's a partnership owned by two or more people, they have to split that money two or more different ways. However they determine is feasible. Also, the rights of each partner, the sharing amount for each partner. So that means if you brought in more money than I did, you probably get more of the income than I do at the end of the year. Also, anything that is tailored to any kind of withdrawal from the partnership, however you stipulate a person is going to get out of the partnership and how a person is going to be admitted into the partnership, all of that is in the agreement. Next is limited life. So what do we say? What do we mean by limited life? A partnership is limited by what extent?
Think that death, bankruptcy, or even taking away the ability of a partner. So like withdrawing from the
Right. So either somebody has to die, right? The company has to go into bankruptcy and everybody has to part ways, or a person can just elect to be withdrawn from the partnership, or you as a partner and other partners can elect to put someone out of the partnership. That's why we call it limited life. How about taxation? The taxation, the partnership by itself is not taxed. However, because they are partners and because they receive income in some form from the business proceeds or profit, then that means that they're going to be taxed personally on whatever they receive from the business. So I want you to be clear. As far as corporate tax is concerned, partnerships are not eligible under that. Okay, it's not taxable. However, the income that is shared and distributed to the partners, that is taxable on their personal tax return, okay? And then mutual agency. So what does mutual agency mean? That just means that if me and you go into partnership, I can make decisions on the behalf of the business on my own. I don't need you to be present. I don't need you to sign anything, right? That's what mutual agency refers to. It means that I have enough power because I am in this partnership with you to go and enter into contracts and do whatever it is that's pertaining to the business without your consent. And I can tell you about it later. Co-ownership of property. So you know already owners can invest both cash and what else into a business?
Property.
Assets, right? So the partnership is the same. The thing is, you might have one partner that will come in with assets, physical assets, and you may have a partner that will come in, good morning, have a partner that will come in with just cash. Either way, it doesn't matter who came in with what. Once you're in that partnership, it all becomes combined. And if we shut down this partnership, if we disband, if we go into bankruptcy or whatever, you can't go and claim that property on your own. It has to be distributed amongst two. Who has co-ownership of it?
The other partner.
Other partners that are in that partnership with you. Unlimited liability. What's unlimited liability? If you're in a partnership together and you split the money, you split everything else, what else do you think you're going to split? The debt. The debt. So even if a person, because it's not unheard of, even if a partner comes in with debt, if you choose to go into a partnership with them, at that point it is no longer just that person's debt. It becomes yours as well. And if the question is why would someone do that? Because what if that partner comes in with way more money than they do debt? You're okay with taking on that debt. If they came in with $500,000 cash but only had $50,000 in debt, that's something you're probably willing to be okay with, right? Because $500,000 is way better than what? $50,000. Right. So if they come in with $500,000 cash, even if you wanted to take $50,000 of that and put it towards their debt that they're coming in with, you have that option because once they join the partnership, it now becomes yours as well, right? Okay. So, organization with partnership characteristics. These are some different types of partnerships. I think sometimes everybody is confused by the term limited liability. And so we're going to talk about it. There are some partnerships that are considered to be LPs, meaning limited partnership. What does that mean? That means that you probably had two or more partners. More than likely, one partner is a limited partner. The other partner is a general partner. The general partner is the person who has to get their hands dirty every day. That is the person who is dealing with the operations. They're making the decisions. They are actively making that business function every day. The limited partner is what we like to call the silent partner. That's the person that came in with the money, but does not want to be tied to the debt and the operations and all the things that goes along with it. So they just put cash towards it. That's all that they want to do. Okay. What does that do for the general partner? It puts the general partner in the bind almost because they could have just been in business for themselves. But they probably got the limited partner because they needed the money. But the trade-off for that is the general partner has to deal with the bulk of the debt. Because they do what? The bulk of what?
The job.
The job, the work. So it's kind of a catch-22. I got a partner that literally does nothing in this business, and I have to deal with their debt simply because we're in a partnership, but they came in with a lot of cash, and I needed that for my business, so I deal with it. Okay, limited liability partnerships, LLP. This is generally what you see for attorneys, medical practices, right? The reason being is because that holds one partner accountable for any negligence. So for instance, when you see a medical group, like it may be dermatologists, but it's 6 of them in there, and they're LLP, bless you. The reason for that is because if you have some kind of malpractice issue, some kind of negligence issue that you dealt with a patient, I'm not liable for that, even though I'm in a partnership with you. You're liable for that. And that's only fair, right? If you do a bad job, you should be the one held for the negligence, not the entire partnership. Limited liability corporations, or LLC. This doesn't have to be formed as a partnership. It can be, but it does not have to be. A LLC could be a business that's owned by one person, but they're a limited liability corporation. All this means is that the owner of this corporation is not held liable personally for anything that the business incurs. So debt, all of those things, because we know about sole proprietorship, right? With a sole proprietor, they're liable for everything, right? That's their personal issues at that point. But when you become an LLC, you are saying, I am separate from my entity. Whatever debt my entity incurred, I personally do not have to pay it back. But the business will have to pay it back because it's debt. That's all that refers to. So how do we choose what kind of business form we want to deal with? It's allowed to say, right? I mean, it's really, I really thought that was like a card or something. Wow. Okay, so choosing a business form. We knew about proprietorship. We know about partnership now. We know about LLPs and LLCs. What we have not learned about are S corps and corporations. And truthfully, chapter 13 is more so about corporations. So we'll get into that then. But what you do need to know, a S corp is owned exclusively by stockholders. Okay? Because they get to buy stock into the business. Those are the ones that make the decisions, just the stockholders, because they have purchased stock. Corporation, that can be owned by one person, it can be owned by many. Okay? But they are their own separate entity, legal entity. So, business entity, all of these are business entities, yes. Legal, what do we mean by legal entity? Because for proprietorship, it says no. Partnership, it says no. LLP, it says no. Why do we say that?
Because the person is responsible legally.
Legally?
The business is not responsible, but responsible.
Or is it because there is unlimited liability? Think about it.
On the business part?
Right, proprietorship, because that one person is liable for everything legally, that's the person somebody would have to go after, right? Partnership, they can go after either of those partners, right? Because they're equally liable for whatever happens with the business.
Oh.
What about LLP? They can only go after who? The person that's responsible for the malpractice or the negligence, right? LLC, remember how I said a person is separate from their entity?
So they have to go after
the business. That's it. S corp.
They go after.
Who you think they go after?
The business owner.
Generally, yes, the business, board of directors, all those people that make the decisions. Corporation, whoever owns it is not personally liable, but the corporation itself is. Limited liability, no, there's no limited liability for proprietorship because that single person owns that business, and if they don't have an LLC, they're fully liable. Partnership, no, there's not limited liability. Each partner is liable equally. However it plays out, it is limited when it comes to LLP because it goes towards the person who is responsible for malpractice or negligence. LLC, yes, there is limited liability, limited to who? The corporation. S corp, limited to who? Corp, board of directors, higher ups. Corporation, limited to the business, right? Business taxed. Proprietorship, no. They're taxed how? Personally. Partnership, tax how? Personally, each partner. LLP is still a partnership, personal. LLC, remember I said that could be owned by one person, right? But they still have to pay their personal tax if they get paid from the business. And then S Corp, how are they taxed? Who's taxed? Not the business owner. Who owns the S Corp? Stockholders. So whatever dividends they get, paid, cash dividends they get, they are personally taxed on them because those are their personal dividends or returns from what they've invested. And then corporation, yes, they are corporately taxed. One owner allowed for a proprietorship, yes, that's what proprietorship is all about. Partnership, no. LLP still a partnership, no. LLC, yes, I told you that a sole proprietor can be an LLC, right? S Corp, yes, one person can own it because it doesn't matter. The stockholders make all the decisions for them. And then a corporation, yes, one person can own that. Many people can own it. Okay. Organizing a partnership. And at this point, I'm on page 485 in your book. And this just refers to what's going to be in the contract, right? What's going to be in the contract? How is money going to be divided? How are liabilities and everything else going to be divided? So the first thing says partners can invest both assets and liabilities. I told you that a partner may come in with some debt, right? Along with assets. Now, is it a situation where a partner can come in with just debt? Probably not. Who would want a partner that came in with just debt? What are you adding to the business? And then secondly, assets and liabilities are recorded at an agreed upon value, normally fair market value. So in other words, just because you paid $400,000 for a building that you're bringing in, it doesn't mean that on the market it's worth that $400,000 you paid for it. It may be more, it may be less. Either way, when we record it on the books, when you come into the partnership, we're going to record it at whatever the market value is. Asset contributions increase the partner's capital account. So in other words, if the partner comes in with assets, the amount of those assets is going to be allocated to, a certain portion is going to be allocated to that person's capital account. That's why partners sometimes have an agreement set up where the income that you receive is based on what you initially invested. Because sometimes assets are worth so much, they have to do it that way. Withdrawals from the partnership decrease the partner's capital account. In other words, there may be times where a partner may want to take money out of the business other than income, okay? That's going to decrease from their capital account. They don't just get to take the money and run with it. So this is just telling you how the journal entries that you need to make when it comes to organizing a partnership. If there are any withdrawals, how it needs to be debited from their withdrawal account. The capital account is always debited for their shares of net income or net loss when you're closing at the end of the period. That's generally when they get paid. And their withdrawal accounts are closed to their capital account, just like we do in a normal closing process, right? And you separate the capital and withdrawal accounts for each person that is considered to be a partner. Now, this is an example here. Kayla, Zan, and Hector Perez organized a partnership called Board. So we got how many people? Is that two?
Well, yes.
Oh, that's their full name? Okay.
Yeah,
Two.
the boards is the company.
No, I was looking at this. Maybe I was thinking those were,
Oh.
but okay. I get it now. Two people.
That's the last one.
Yeah, it's weird. Zan's initial investment is $7,000 cash, $33,000 in facilities, and a notes payable for $10,000. And then Perez only invested $10,000 cash. So here's one of those situations where a person came in with what?
Assets as
As well as
cash. Liability.
a liability or debt. So they are doing two different journal entries, right? Why are we doing two different journal entries instead of just lumping it all together? Two different people, and those amounts have to go to where? Their capital account. So They came in with cash. Zan came in with cash, 7,000. He also came in with facilities that were worth 33,000 market value. Also came in with the liability for 10,000. And so, what have we allocated? We've allocated 30,000 to his capital account. Where did we get that 30,000 from? 33 plus 7,000, and then subtract the liability. So this is one of those situations where it's okay for him to come in with debt because he still had enough to cover the debt and for us to move on. He came in with more because he came in with a building and cash, so it's okay. It was way more than the 10,000 debt. Then Perez just kept it simple and came in with 10,000 cash, and that's how much is in his capital account at that date. So dividing income or loss. There are 3 different ways that a partner can divide income or loss, and sometimes there will be a loss. But because partners are not employees, you can't ever consider that to be like a salary or anything like that. We like to call it allowance because that's the more appropriate word to use. So allowance, based on whatever is in the agreement. But it's just basically hitting that point again, how they're not taxed on the business, they're just taxed personally because you're going to do one of 3 things to allocate money to them from net income, and they're going to pay for it how? Personally, on their personal tax return, right? And it's going to depend on what the agreement says. If the agreement says that they split net income equally, that's the easiest scenario, right? It's not always like that. These 3 things, stated ratios, capital balances, services capital, and stated ratios, meaning one or the other, or that third one, you can incorporate all. So this example is for stated ratios. So those same 2 partners, Zan is to receive 2/3 and Perez 1/3 of the partnership income or loss. If the partnership income is 60,000, we will allocate the income to partners as follows. It's relatively simple. 60,000 net income, 60,000 times 2/3 for Zan, 40,000. 60,000 times 1/3 for Perez, all he gets is 20,000. That's simple, right? That's just with a stated ratio. Now, what happens if you have to divide it based on their capital balances? You remember what they came in with? 30 and 10, right? In this case, Zan with his 30,000 balance, the ratio of that out of 100%, 75% of the income times 60,000, that means that he gets 45,000 of that 60. 10,000 for Perez, that's obviously the 25% remaining. There's only 2 partners. Times that 60,000 gives us 15,000 for his allocation of income, and that would show that income has been distributed 100% to both partners.
So to come up with the ratio, they divided it by, they basically said 75%.
Calculator, y'all got your calculators out, right? You just want to check.
I mean, the ratio part is kind of killing me, but I didn't figure 100%.
Do you know what you're calculating?
No, that's why I was like,
You got 2, right? You have 2 partners, and total together is 40,000, right? 30,000 divided into 40,000 gives you 0.75 or 75%. 10,000 divided into 40,000, 0.25 or 25%. The goal is to always get to 100%.
that's where That's why I was tripping on the homework.
You started the homework already?
It was, what, there's 12, all of chapter 12 is here. I thought it's not due today.
You taught me at 12 because you all over.
I'm sorry, like I'm tripping,
It's
yeah.
okay. It's okay. It happens. It's something. It happens. Okay, but y'all understand that part, right? And now this is where we decide to get into both stated ratio and based on capital. Okay, they're just saying these are the conditions of their contract. Zan receives 36,000 annual salary allowance. You remember how I talked about allowance and not calling it maybe wages or something like that. Perez receives 24,000. They get an annual interest allowance of 10% of their beginning capital balances. You remember what those beginning balances were? 30 and 10,000, right? And anything remaining after that of income or loss is allocated how?
Split in two.
Equally. So their net income at this point for this example is 70,000. So we got three things going on here. We got one, they get a salary allowance. Two, they get interest allowance. And three, they split whatever's left equally. Salary, 36,000, 24,000. Notice the 70,000 net income up here. So subtracting 70,000 minus what? 36,000 minus 24,000. What's left is 10,000, right? Interest. Their beginning capital balance is what you are paying the interest on, right? Remember Zan's beginning capital balance was 30,000. Multiply that by the 10% interest rate, get 3,000 allocated for interest for Zan. Perez, beginning capital balance was 10,000. Multiplied by that 10% interest rate gives us 1,000 for interest allocation for Perez. Subtract that from 10,000, that leaves us with 6,000. And how are we going to split the 6,000? Equally. So each person is going to get 3,000. Is that understandable? They stated it. Yeah, they stated it in this previous part here, saying that their salary allowance, and it's generally like that in the problems as well. Okay, now, remember before the net income was 70,000, that's plenty, right? This is a situation where net income is not plenty because now it's only 50,000. Once you even take out their salary allowances, we're in the hole 10,000. And then the interest, still the same, hasn't changed, but now we're even further in the hole by 14,000. And that 14,000 we have to split how? Equally. So what this means now is that from each person's capital balance, we're going to subtract that 7,000. So from that 30,000, we're going to subtract 7,000, and from that 10,000, 7,000. So that means that Perez would only have how much remaining in his capital account after that? 3,000. 3. Remember, he didn't start. What did he start off with? 10,000. So if we subtract that negative, he's only going to have 3,000 left in that capital account. From the 30,000 for Zan, they're going to have how much left? 23,000. So this is a statement of partners' equity. This has to be done for the sake of knowing what may be the ending capital balances. They're going back to the example of the net income being 70,000. They're also showing you in this example, Zan has did a drawing or withdrew 20,000 of cash. Perez has also taken 12,000. So remember their capital balances that they started off with, 30,000 and 10,000. All of their computations, 42,000. So they were negative 20,000 for. No, sorry. 42,000 plus 30,000 minus their withdrawals of 20,000. Capital balance is 52,000 for Zan. Perez 10,000 plus 28,000, 38,000 minus 12,000. He has 26,000 left, right? But then they're going to show you another example, or maybe not. Thought they were going to show the negative, the 50,000 net income, but I guess not. Okay, so admission and withdrawals of a partner. Remember how I said people can kick people out? They can get more people if they wanted to, but they cannot kick anybody out of the partnership. This is what this refers to. So it says when the makeup of a partnership changes, the existing partnership is what? Dissolve. What does that mean? If me and Mary and Mr. Coleman go into partnership together and you want to kick me out and bring someone else in, whatever agreement we had in place is null and void at that point, because I will no longer be a partner. So you have to let me go my way, and you have to draft an entirely new contract between you and the new partner, whoever you choose to bring in. It says the new partnership may be immediately formed, so you don't have to wait a certain amount of time. You don't have to have a break before you admit a new partner or even withdraw a partner. You can do it right away. The new partner acquires partnership interest by either purchasing it from existing partners or investing assets in the partnership. And I'm going to show you what that looks like going forward. And at this point, we are on page 488 in your textbook. Almost through. So, purchase of a partnership's interest. A new partner can purchase partnership interest directly from existing partners. The cash goes to the partners, not the partnership. To become a partner, the new partner must be accepted by the current partners. So this is a situation where a partner can come in and it will be a bonus to the old partners. In other words, not money going into the partnership, but we're saying we're going to accept you as a partner, but you're going to have to pay your way to get in. Does that make sense? So it says on January 4th, Hector Perez sells 1/2 of his partnership interest to Tyrell Rashid for $18,000. Perez gives up $13,000 recorded interest in the partnership. So Perez was already existing, correct? The new partner is who? Rashid. And how much did he have to pay to get in? How much did he pay to get in? Where do you get 18,000? He sold 1/2, but how much was the 1/2 worth? 13. He sold 1/2, which would have been that 18,000, but it was only worth at that point 13,000. So that 13,000 is transferred to Rashid. Now, why is it coming from Perez but not from Zan? If Zan is a partner as well. Not because he's still a partner, but what? He's not selling any of his interest, right?
Right.
Zan didn't elect to sell interest. Perez did.
So he's still a half partner, and basically their partnership is now.
Now they have a third partnership.
So he sold part of his.
To admit
Another person.
the new person to come in. So now what changes, because now we have 3 partners instead of 2? What did we just talk about changes once you start admitting and withdrawing partners? The contract, the agreement.
So now they got to throw away that one and make a new one.
The old one is null and void, and the new one has to be put into place now. So investing assets, because we know they can come in with more than just cash, right? But when they invest assets or bring in assets, that does what to their capital account? Increases, good. So on January 4th, Tyrell Rashid is admitted to the partnership with a payment of $22,000 cash. This is all he had to pay to get into the partnership. Notice nobody sold their interest. Nothing else is happening right now with the remaining or the existing 2 partners, right? It's just showing that he came in with $22,000. His capital account balance is now what? $22,000. Now, this is where it gets interesting. When they admit a new partner, it can go two ways. It can either be a bonus to the existing partners, or it could be a bonus to the person coming in. Under what circumstances would it be a bonus to the old partners? We're saying you have to pay us to get into our partnership, right? And you're not just going to pay us cash, but you're going to pay us cash plus interest and anything else that we require for you to get in. But if it's a bonus to the new partner, generally that's because that new partner may have some resources that they don't already have access to. So they say, we really want this person. So not only are we going to admit them into the partnership, but we may even give them a cash incentive to be a part of it. So here's the example. On January 4th, Zan and Perez agreed to accept Rashid as a partner. How much did he invest? And how much ownership is he going to receive? 25%. What does that 25% signify? Which means if the business disbands, or he gets at least 25%. It may even be more depending on what has been dissolved. However, he can't get less than 25%. So it says any bonus is attributable to the existing partners and shared how? So is this a bonus to the partners or a bonus to the new partner? Really?
Well,
It just said any bonus is attributable to who? Existing. So is it a bonus to the new or to the old? To the old. So equity of Zan and Perez. This is basically their equity balance, both of their capital balances added together. The new person came in with 42,000 cash, right? So now that makes total equity increase to 120,000. He also got how much interest? 25%. So we multiply that, and his capital balance is now how much? 30,000. So this is the journal entry for that, right? It shows that we received how much in cash? 42,000. And then Rashid's new capital account, we said, was established for 30,000. This is where their bonus for the existing partner comes in, because he had how much remaining? 42,000 minus 30,000, which was at 12,000. And it said that they were supposed to split it how? Equally. So each partner got an additional 6,000 in their capital accounts.
that's why it was a bonus for the
Mm-hmm.
existing person.
Bonus to existing. Now this is an example where a new partner is clearly coming in with more resources, so it's a bonus to them more so than the existing partners. So they agreed again to accept this partner. How much did he invest this time?
18,000.
So that's essentially less than, what was it, 42,000 from the previous part? And he still got how much interest? 25%. Same amount of interest, but he had to invest less cash on the front end. So that's a bonus to him. So again, their equity balance didn't change. The existing partner, 78,000. He invested his 18,000. That brought their equity up to 96,000 total. He still got his 25% interest. And now his equity balance or capital balance is how much? Now that's less than the 30,000 he had before, right? Look at this journal entry. Now, instead of him giving them 6,000, what are they having to give him?
3,000.
Each. So in total, he got 6,000 for just joining. He invested only 18. He still got 25% stake in the company, and he also received 6,000 in his capital account from both of them. A total of 24,000. So now, remember their existing capital balance was 78,000. That's obviously going to be decreased by how much? 6,000. Good. So withdrawing of a partner. We know that there's no time stamp on that. They can withdraw a partner anytime they choose to, right? There's two ways a partner can get out. Either they can decide to sell their interest to somebody else that's already in the partnership or even a new person coming in, or they can distribute their cash and anything else they had in that capital account to the person that's leaving. This is an example where it's just an even break. This person wants to get out of the partnership, Perez, and Rashid is coming in. Perez only had $38,000 in his capital account, so that's all he got. And that's the way that they got rid of him. And so now it would just be left Zan and Rashid for $38,000. This is an example where the person that's leaving will have to share some of their capital balance with those who still exist. So he's withdrawing out. He only had $38,000 in his capital account, right? They're buying him off. They're saying, we know your capital account is worth $38,000, but we're only going to give you how much? $34,000. And whatever is remaining, we get to split amongst the new partner and the old existing partner of $2,000 each. This is where the withdrawn partner gets to go out with way more than what was in his capital account. So in this case, they are paying him more money for him to leave. Imagine that. Wouldn't you rather have that situation where you had more than what your capital account states? So his capital account, we know, was still only worth $38,000, but we paid him how much to leave? 40, which means that each partner had to soak up a $1,000 cost in order to let him go and get rid of him. He could have been a bad partner. He could have.
What determines that? Just
No,
the
I
agreements,
asked about the other
just depending on the agreements of withdrawal at the beginning, or like what determines that?
I think that's a choice. That's a choice among, because remember, when Rashid joined, whatever partnership agreement that was in place, what happened to it?
It was null and void.
It was null and void. So there was nothing in place that said if we kick out somebody, we have to pay them more than the capital balance. He could have just been that worrisome that they wanted to get him out so bad that they were willing to pay an extra $2,000 just to get rid of him. Does that make sense?
Mhm.
So that doesn't have to be in the agreement. So remember how we said the way that a partnership dissolves is by what? Death or bankruptcy. Or what else? There was one more.
That was the one we first withdrawal.
Right, or the withdrawal of a partner. In this case, if a person dies, all this is saying is not only, you can't just go in and say, the business has X amount of cash, let's just distribute that, and that's it. You have to go through a couple of processes. First, you have to close out the books after that person dies. And you have to figure out whether the business had a net income or a net loss, right? And remember how some partners came in with assets or even debt? You got to make sure that that stuff is valued based on market so that you can do what with those? Sell them, pay off the debt, and distribute whatever is left amongst who? Whoever's remaining. And if the death, that doesn't mean that the person that died, that you don't distribute anything to them because they may have an estate, right? And so you still have to distribute what is theirs, what they're entitled to their estate. So here's the liquidation, 4 steps. I need you to remember these. These are very important. Non-cash assets are sold for cash and a gain or loss is recorded, right? The reason why we care about whether or not they were sold, we need to know what it was sold for because that has to be distributed after liabilities are paid, of course. Gain or loss on liquidations is allocated to partners using their income and loss ratio. So you remember that stated ratio we talked about? That's where that comes in. 3, liabilities are paid or settled. Nobody can get any kind of money from liquidation of the business until debt is completely satisfied and paid off. Lastly, any remaining cash is distributed to partners based on what? Capital balances. So you remember how Zayn and Perez came in with how much? Zayn had how much in his capital? 30,000, and Zan had how much? I mean, Perez, 10,000. So this example, no capital deficiency, means that each of the partners had 0 in their capital balances. They give you an example here. Zan, Perez, and Rashid agreed to dissolve their partnership. The only outstanding liability they had was about 20,000 in accounts payable. And so prior to them dissolving, the partner has the following balance sheet. This is how much cash they had on hand. This is how much assets were worth at that time. That accounts payable or debt that was sitting out of there. And notice, just write down on your papers in front of you what their capital balances are at the end of January 15th. And it's 3 of them. So they're going to begin this process of dissolving the business, right? First, they're selling the land. Remember, it was worth how much?
400.
Oh.
The land.
40,000.
40,000. How much did they sell it for?
46.
So that means that they have to recognize
Gain.
40,000 for land, and the rest is distributed how? Equally amongst the 3 partners. So 2,000 for each of them to go in their capital accounts. Remember how I told you that debt has to be paid off before anybody can get any income? They're paying the accounts payable off with 20,000 cash. So look how their balance sheet has changed now. What were the balances for these before?
They had 70,000.
Mm-hmm.
Perez had 66,000.
Mm-hmm.
And she had 62,000.
So everything, all of their capital balances have increased by 2,000. We show that we only have 204,000 cash left, right? After we paid off that accounts payable. Capital deficiency means that at least one partner has a debit balance. So that means somebody owes, yes. Their capital balance is significantly not adequate. Zan and Perez agree to dissolve. What's happening now? Rashid has negative 3,000 in his account. Everybody else has a positive capital balance, right? So he has to pay, and he's able to pay that 3,000. So he just gives them 3,000 cash because the business is being dissolved. So he just pays it off and brings him down to 0. And then this journal entry just shows their remaining capital balances and then the cash being distributed for that. But what happens if he can't pay it? Look at what happens. Who has to absorb those costs? The remaining partners. And why? What's that rule we talked about when we first started?
You have to split the debt.
You have to split the debt equally or whatever is according to the
Contract.
contract. So ending balances, remember Zan had 19,000, Perez had 8,000, Rashid had a negative 3,000. Because they have to absorb his costs, each one is going to be liable for 1,500 to 0 his account out, and their remaining capital balances, 17,500 for Zan, 6,500 for Perez. So this journal entry shows that they transferred his debt to them. This second journal entry just shows what is remaining in their capital balances to be distributed to them. Okay. So that's it. You need a break before we do problems? Okay. 15 minutes?
You say you needed more than that? You can run 20 minutes. You're trying to shorten it up.
Always trying to get those extra 5 minutes. No. 15 minutes. You come back.
Okay.
If I give you the extra 5 minutes, it might be next week. Okay. So starting with exercise 12-3. It says, on March 1st, 2013, Eckert and Kelly formed a partnership. Eckert contributed 82,500 cash, and Kelly contributed land value at 60,000. and a building valued at $100,000. The partnership also assumed responsibility for Kelly's $92,500 long-term note payable associated with the land and building. The partners agreed to share income as follows. Eckert is to receive an annual salary allowance of $25,000. Both are to receive an annual interest allowance of 10% of the beginning year capital investment, and any remaining income or losses to be shared equally. On October 20th, 2013, Eckert withdrew $34,000 cash, and Kelly withdrew $20,000 cash. After the adjusting and closing entries are made to the revenue and expense account at December 31st, 2013, the income summary account had a credit balance of $90,000. One, the first thing we're supposed to do is prepare journal entries to record A, the partner's initial capital investment, B, their cash withdrawals, and C, the December 31st closing of both the withdrawals and income summary account. So, in light of the first thing that we're supposed to do is the journal entry to record the initial capital investment and what was invested in. What was invested in? Because at this point, we're doing a journal entry. This is March 1st.
You got 82,500.
So cash for 82,500.
Land for 60,000.
Land 60,000.
And the building for 100,000.
Okay, so those are all our debit accounts. What do we credit?
The note payable.
The note payable that they came in with? $92,500. What's next? You got two more things because that doesn't balance. All of this is for what purpose?
What in the capital?
Yeah, to report their capital account. So how many partners do we have? Two, and what's their name?
Eckert, Kelly.
Eckert and Kelly. How much are we going to allocate to Eckert's capital? How much did he come in with? Eckert?
82,500.
82,500. What about Kelly?
Land and building.
160 minus what? Didn't he come in with a note?
Yes. Yes.
Yes.
60 minus 958.
How much is it?
But I thought you do their capital separate.
What do you mean? What goes in their capital account is what they came in with. So if he came in with 160,000 in assets and a 92,500 note, what's the only thing that's going to go in his capital account is how much?
67,500.
67,500, and that 67,500 is just what he came in with of 160 minus the 82.5. I mean the 92.5, right? And at that point, all of everything belongs to who? Both of them. I want to say, Ms. White, that's what you were asking.
No.
Okay. What were you asking?
Because you did a problem earlier where you said you had to do two separate capital accounts, which is two separate,
Yeah, well, they did it that way. We can do this way. Why do I say we can do this way? It really doesn't matter if you do it separate or together, but the reason why we had to do it together because that's what the problem required.
When we start journalizing, we journalize the accounts separate.
Yeah, you could have. When we did that example earlier, it was each person's, right? And I want to say this is in your homework too. I could be wrong. But in your homework, it only gives you space for one journal entry for that. So this is how we combined it. But if you wanted to,
that's what was confusing me.
okay, if you wanted to stick with the separate, you could have did it separate as well. It still would have came out to the same.
Okay.
Part B says we have to record their cash withdrawals. So how are we going to show what was taken from the business as far as cash?
You subtract it from capital.
Subtract it from capital. What do we debit?
Income summary,
We haven't got there yet.
withdrawal,
Whose withdrawals?
whoever withdraws.
Separate withdrawals. So Eckert and Kelly. How much for Eckert?
74,000.
How much for Kelly? And what do we credit?
Income summary.
What did they get?
Yeah, well,
Cash. What's the total amount of cash?
54,000.
What does C ask us to do? What are we recording for C?
December 31st closing of both the withdrawals and income statement, income summary account.
Income summary. You remember income summary from Financial Accounting 1?
Yes. It's a
Temporary clearing account. That's correct. So remember the process at the end of the closing was that we closed out expenses to income summary. We closed out
withdrawals to capital.
income summary to, I'm sorry, we closed out revenue
To income summary.
to income summary, and then close out income summary to capital, and then withdrawals we close out. So in this case, since we're only dealing with the withdrawals, what do we debit and what do we credit?
Debit the withdrawals and credit the.
But remember, the normal side of withdrawals are debit. So in order to close it out, you got to do what to it? You got to do the opposite. So you got to credit. So we're going to debit what? Because we're closing this at this point to
Debit capital.
Where'd you get that from? Oh, I thought we were having something here. Okay. So Eckert, capital, Kelly capital, those are debited. And what is credit?
Income.
They're withdrawals, isn't it?
Withdrawals, yeah. Both withdrawals accounts. Like,
Eckert withdrawal, Kelly withdrawal. So what amounts are we recording for? Because they're going to be the same. What's the amount of withdrawals?
34,000 and 20,000 on both accounts.
So 34,000, 20,000, the same for both sides. Now we gotta close these close the, what account? What's the clearing account?
Income summary.
Income summary. So what's that journal entry?
If you debit capital.
Debit capital?
Debit income summary for the amount of the withdrawals, which is like 54.
Of the withdrawals? You sure? Debit income summary, credit what?
Capital,
Capital, each person's capital account.
the amount of the income, right?
Do you know what the income is?
One was like
One was 28,075, and the other one was like 14,425.
Right, but that's not what it is now, though. What do we have to go through before we can find out what their capital balances are?
You have to do the withdrawals, that
Not
whole
just
sheet.
withdrawals, what
I
else?
mean, the sheet, the income, like based
Their-
on investments
Yep.
and that whole sheet.
Their share of income.
Statement of partners equity. That's
Well, you don't have to do a whole statement, but you at least need to know
what's
how
the
we need to
income.
allocate it, right?
Yeah.
So, let's go through that. The first thing they got was a salary allowance.
Uh-huh.
Is that what it is?
Yes. And then you calculate the interest allowance, and then you balance the
So we're gonna
allocated
do Eckert and
then
Kelly. What's their salary allowance for Eckert?
Hold on. Try to find it.
25,000.
25,000. So Eckert's salary allowance was 25,000. What about Kelly?
He didn't have it.
0. So what did we start off with? What was the net income?
Was it 160,000 that time?
They stated it.
60,000.
90,000.
Where is that at? Had a, okay, income summary had a balance of 90,000.
And 90,000 obviously minus the 25,000 gives us how much? How much? 65,000. Now, what else did they do as far as share income?
8 times the interest,
Interest, what was the interest rate?
10%.
So interest allowance, 10% of what?
The income.
Beginning capital.
Yeah, the beginning account.
And we said over here, beginning capital for Eckert was 82.5, and for Kelly was 67,500. So
Yeah, I forgot to subtract the notes payable from
times 10%. I'm just gonna make a line. We do it times each one of those, right? And how much would the interest be for Eckert? You don't have to calculate that. You can look at that and tell what's 10%.
$8,250.
$8,250. What about Kelly?
$6,750.
6,750. Lord, it's punching calculator. Okay, so add these two together. What do we get? $15,000. And obviously, when you subtract that from 65,000, what does it leave you with? 50,000. And then what's left after that?
The least which you have to balance the.
They share equally, do they not?
Yes.
$50,000 divided by 2 means 25,000 for each person. Are we correct?
Yes. So once you add that.
I want you to add both of these columns up for me. What's the total for Eckert and what's the total for Kelly?
58,250 for Eckert.
58,250.
That one is 31,700.
Okay. Now,
That's just based on if the allowances were great, because the allowances are greater than the income exceeds the allowances.
correct.
Correct.
Now, at this point, we have to find out what their ending capital balances are. Because for the sake of this journal entry, we're fine. Right? Because we
Where do
just
you get the,
get what? I'm sorry.
The 225,000 on the bottom.
The 50,000 left over from the interest allowance, the 15,000 subtracted from the 65,000 equals,
Right.
yeah, and they have to split the remaining equally. So up here, back in this journal entry, 90,000, Eckerd's capital, 58,250. That's where you put that. And then Kelly's capital, 31,000 that we're closing out. This is how we're allocating this income summary or net income. 31,750. We're still not done because we have to find out their ending
Capital balance,
capital balances.
you add the 82.5.
You start with that. We got to start with their initial investment, and then we have to subtract what?
The payable,
You've been saying it all along.
the notes.
The withdrawals.
Yeah.
So initial investment for Eckerd was at 82,500, right? Kelly, it was the 67,500, and then their withdrawals. How much was it for Eckerd? It was 34,000, and for Kelly, it was 20,000. And what else do we need to include?
Income.
The share of their income. So the share of their income for Eckerd, it was 58,250. For Kelly, it was 31,750. So that means ending balances were how much for Eckerd and then how much for Kelly?
For Eckerd, it was 106,750.
Okay, Kelly?
$78,000.
78,000?
I got,
750. I got 78,750.
I got 79,250.
Okay, before I write it, double check. 67,500 minus 20,000 plus 31,750.
And 79.
79,000.
Yeah, 250.
Okay. Take a deep breath, because that's it for that.
So that means because I didn't take the notes payable credit from that, from the equity, from Kelly's capital, my whole sheet was off
Yep, that's gonna be like that.
because I forgot that one step. Well, I had the right concept, but my numbers are off because I forgot that one step.
Thank you. You guys have all of this?
Yeah, but
Yeah.
Okay.
the 10% for the 82,500, what that do? 82.
50? Yeah. To 82.50. So the next problem I told you to do was exercise 12-4. Angela Moss and Autumn Barber organized a partnership on January 1st. Moss's initial net investment is 75,000, consisting of cash, 17,000, negative 17,500. Equipment, no, it's not negative, they're just expressing it that way. $17,500, equipment $82,500, and a note payable reflecting a bank loan for the new business, $25,000. Barbara's initial investment is cash of $31,250. These amounts are the values agreed on by both partners. Prepare journal entries: 1, to record Moss's investment, 2, to record Barbara's investment. So for the first journal entry, we're recording what Moss invested. This is one of those separate things. We didn't put it together this time, right? Just separate investments. So how do we record the first journal entry? What do we debit? What do we credit? Because what did Moss come in with? He came in with cash. What else? Equipment and a debt, right? So what do we debit?
Debit cash and equipment, and we credit the notes payable.
Debit cash, debit equipment, credit notes payable, credit Moss Capital. Thank you, Mr. Coleman. Okay, how much for cash?
17,500.
Equipment,
82,500.
$82,500. How much for notes payable?
25,000.
How much for Moss's Capital? Remember, you would have to. You sure? It's the 82,500 plus 17,500 minus the 25,000. Okay. And so the next journal entry that we are supposed to record is to record Barbara's investment. And what did he invest? On cash. So tell me what to debit, tell me what to credit.
Cash, 31,250, and Barbara's capital was the same amount.
Barbara Capital, 31,250. Very simple. I'll let you get that down. The next one we'll have to do is exercise 12-5. Kramer and Knox began a partnership by investing $50,000 and $80,000 respectively. During its first year, the partnership earned $160,000. Prepare calculations showing how the $160,000 income should be allocated to the partners under each of the following 3 separate plans for sharing income and loss. The partners failed to agree on a method to share income. 2, the partners agreed to share income and loss in proportion to their initial investment. 3, the partners agreed to share income by granting $50,000 per year salary allowance to Kramer, $40,000 to Knox, 10% interest on their initial capital investment, and the remaining balance to be shared equally. So we got 3 different assumptions, right? 3 different plans. We talked about those in the lecture. What is this, 4? 5. Thank you. Okay, so under plan 1,
They equally,
they share equally.
if there's no agreement in place, correct?
And when there is no agreement in place, you must just share or distribute everything equally, right? So Kramer and Knox.
So it's like 80,000 apiece at first. Number 1. With the income for that year, then the income was 160,000.
So we have net income of 160,000, and we're obviously gonna divide that by
Two,
2. So how much for each partner?
80,000.
80,000. What about plan 2?
The ratio, you would divide it by the total.
What's
Like
the
it says
ratio?
60 is 60 by 100 over 140,000. And 80, that's where.
They said they share income and loss in proportion to what they initially invested, right? So,
That's why I got that 60 and 80 over, I added the
You're right.
140.
you're right, I'm not saying you're not right,
Oh,
but we have to go through, because remember, the online class is watching this.
oh,
So we need to go through how we got what we got.
okay.
60,000 was what, who initially invested?
I think Kramer,
Kramer invested 60,000.
and I think Knox did the 80,000.
Knox did 80,000. Obviously, if we add the 60,000 plus the 80,000, that gives us a total of 140. So that's what we divide by for each of them, right?
Yes. And it's 3-7 and 4-7, so the ratio is 3 against 4.
You got there yet?
But
What do you do with, after you have divided these, what else do you need to do? Because it wouldn't be done at that point. Don't you still have to account for net income? Because that's the whole purpose of all of this.
okay.
So you need to multiply by the total net income amount,
Oh.
because that's what you're allocating. So 60,000 divided by 140,000 times the 160,000 gives us how much for Kramer? 68,571. What about for Knox? 91,429. So we just bring that stuff over, right? Because you need to get a total. Ultimately, it's supposed to equal out to what? What did you just allocate?
160,000.
160,000. What's the third plan?
Determine the ratio.
They used ratios, or did they use a couple of things?
This one was supposed to be.
They had salary. They also had interest as well, right? So we still have to, no matter all of that, we still have to start off with what the net income was. Which was 160,000. And then starting with their salary allowance. Kramer had how much? Kramer got 50,000. What about Knox? 40,000. You just bring that stuff over. Subtract it, right? What are we left with? 70,000. And next, what do we do? Are you sure 70,000? 50,000 plus 40,000 is 90,000. 90,000 plus 160 is not 70. Or is it? Yeah. So now, with interest, what do we do? Are you telling me or are you asking? Telling me. And what are you multiplying by the interest rate? Salaries? What do you multiply by that interest rate? First of all, what is the interest?
10%.
10%. And what do you need to multiply times that 10%?
The initial capital.
That's it. What was the initial for Kramer?
60,000.
60,000 times that 10% means he got how much interest?
6,000.
6,000. What about Knox? 80,000 times that 10%. Bring that over. Oh, wait. When you subtract 14,000 from that 70,000, what's the remainder? 56,000. And how are we supposed to allocate this?
Equally.
Equally. So balance allocation, 56,000 divided by 2. How much per person? 28,000. For a total of what to subtract? 56,000 to make it 0. Right? That cancels it out. What are their separate balances now? So 50,000 plus 6,000.
84,000 for Kramer.
Uh-huh.
And then the other one is 76,000.
Good.
What's the ratio?
I'm just on my
Like, so we talking about a ratio. Like, what did you say? Hold on, wait. I wasn't ready for that.
So what does the 84 and 76 show?
That's their ending what? What's the 84?
Oh, for all those amounts. Okay.
That's not the ending capital, but what is it? The whole purpose of this was for us to find out what?
Their salary?
Shares of income. That's what that was for. We did all that to find out how much of the net income each person gets.
Okay. So
Now, what was? How do people do this? That was in my freaking window. Goodness.
Sorry.
Okay, where did you see ratio?
I think I seen that on that ratio thing where we start our ratio, find out the ratio of the, the allocation of stated ratio.
Well, we ain't got that because I don't think that was here yet. That wasn't for that particular problem yet.
Oh, Lord.
Y'all get it one day, I don't know when.
Wow.
So their shared income is like their yearly salary?
Yeah, and I don't want you to say salary, but just say yearly allocation
And the share income,
of net income.
Let's say 10%.
is the portion of the net income each receives, right?
Yeah, their share of it. You have to use the word share. The word share is important because it's a what type of entity?
Oh, a partnership.
A partnership. So if we can successfully, and I say that lightly, if we could successfully get through exercise 12-6, then I will allow you to go for the day. Because I realize you're tired. This stuff is running all through together and it's affecting you greatly. So, And probably a lot of this last week, when I told you what probably to do, a lot of it didn't make sense last week and it makes more sense today. So next week, we're going to definitely get into, more problems. All right, so exercise 12-6. Assume that the partners of exercise 12-5 agrees to share net income and loss by granting annual salary allowances of $50,000 to Kramer, $40,000 to Knox, 10% interest allowances on their investments, and any remaining balances shared equally. Which is what we did we not? We did that in the second part. Down there. So it says determine the partner shares of Kramer and Knox, given if the net income was $98,800. So they're just giving us a different assumption.
Right.
And what I shall do,
If the income was $160,000. So we still do the same steps. We just. Stop.
oh no, it doesn't. It doesn't. Yeah, it blinks like this.
Delete that part, so we can do
I hope I didn't put the voice here. Oh no.
pop up with that. But
Yeah, it's recording. It's recording. All right, so what was this exercise? 12-6. And we're doing the same process, it's just the net income has changed, right?
it's gonna be a loss.
Hold
The
on.
allowances are greater. I think I kinda did that one.
What's the interest rate? Still 10%?
10%.
All right, so their net income was how much now?
98,000.
Even?
800.
98,800. $98,000. It was 98,800. All right, what was their salary allowance? What was it for Kramer?
50,000.
It's still 40,000.
Yes. We got the interest.
How much is left now?
5,000. Well, yeah.
90.
8,800.
8,800. And then interest allowance.
5,000.
10% times what?
50,000.
That's supposed to be on their capital investments.
Yeah.
What's the capital investment?
60,000.
60,000, 80,000. So it's still 6,000 here. 8,000 for Knox. A total of 14,000, right?
Mm-hmm.
Which means that we are in the rears how much?
$7,000 per person. Yeah.
No. What's the total here?
14,000. Oh, minus the 8,000, 5,000.
You're in arrears 5,200, and then obviously we need to allocate that equally, right? 2,600. So how does that change their, how does that change their balances now, their ending share of income?
Well, they have a loss.
Yeah, what is it?
This is why I got to do that.
No, it's not. 50,000 plus 6,000
Right.
minus 2,600.
You said minus 6,000, right?
53,400.
53,400. What about for Knox? 40,000 plus 8,000 minus 2,600. 45,400 is their share of income. And that is for number 1. What about number 2? What's the net income now?
They have a net loss of 16. I mean, 800.
I want to do it. I hate this thing. All right, so it's a net loss, you say? How much is it?
18,000.
18,800.
18,800.
What is their, does the salary allowance stay the same?
Yeah.
So we know that that is 6,000. No, 50,000, 40,000. Which means that when we subtract 90,000, how further are we now in the arrears?
$106,800.
And we know that their interest has not changed. It was 6,000 and 8,000 respectively, which means when we subtract 14,000, we have how much of in arrears now? Well, you're technically adding, but how much is it now?
What are we doing, adding?
106,800 plus 14,000.
12800.
128,000. Are you sure?
No, 128,800.
120,000.
120,800. What do we do with this? The negative. We still have to split it with what? Equally. Which is how much for each person?
50,400.
So 60,400 from this partner, 60,400 from Knox, which means their shares of income under that assumption is how much for Kramer? 50,000 plus 6,000 minus 60,400. Say it again.
4,400.
For Knox,
That's not right. Yeah, 56 minus 60,400, that would be 4,600. Right?
y'all tell me, I'm not up here with a calculator, so I'm trusting in you to be able to calculate it properly. What is it?
Yeah, oh, yeah, no,
3,600.
he was right, 4,400.
Okay, I'm getting two answers. Please pull out your calculator and calculate it properly. 50,000 plus 6,000 equals 56,000 minus 60,400.
That was right, 4,400.
What's the second one? 40,000 plus 8,000 equals 48,000 minus 60,400.
12,400.
That's how they would divide the losses, correct?
Mm-hmm.
So, shares of income down at the bottom, we got the parentheses.
Because it's negative. Meaning a loss. Um, Vanessa, Montana, Chicago, Comey, Pierce, Portis, Michelle White, all right, next week, we still have to go over problem 12 dash, exercise 12-7, exercise 12-10. I'm going to throw in there exercise 12-11. And then problem 12-3, and then we will talk about chapter 13 as well. So just write them down, make sure you have them. Exercise 12-7, exercise 12-10, 12-11, and problem 12-3A. We'll do those in class next week as well as go over start chapter 13. Breath. Don't forget everything between now and next Tuesday. Please. Thank you. Thank you.